In this week's update, stampede but not many horses. US market flashing potentially concerning signals. Where are the risks in equities? And where to go for gold and silver? My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. It was a pretty volatile week, and before I get into this first slide, I just want to show you some charts of some of the key stocks that give you an indication of what is really happening under the hood in the market. And you don't get this sort of clarity unless you look at a few hundred stocks. You just don't get it from the indices. So I just want to look at Nvidia, Google, and Tesla just to give you a sense of what actually happened. So last Thursday, Friday, there were some significant falls, but from then on, the world's biggest company, Nvidia, was down 7% in 2 days from here down to here, and 10% across the last 3 days if you take it from the peak that it recently formed. So what we saw was quite a bit of intraday volatility, but it was really lacking volume. And you can see down here the overall daily volumes. There's no increase there at all. It's really quite mild. So we saw plenty of intraday volatility, but it's not really the sort of panic selling that marks a top in the market. So the way that I see it is that it's a change of character, but on extremely short timeframes, as in hourly kind of timeframes. So a lot of volatility. Now, that doesn't mean that this isn't a short-term top in the market, but at the moment, it doesn't look like it's a particularly scary one if it is going to develop. And if we look at Google, and the main thing to look at here is where the price finished and what the volumes were. And you can see that Google actually rose on the week, and there was no significant increase in volume on the selling. And very similar with Tesla as well. So some of the headlines about the volatility and the potential peaks in the market are actually pretty misleading when you look through 100 or 200 stocks, as I do every day, and sometimes more than once a day. So that's the backdrop to what this video is about. It's really that there is certainly some volatility on a very short-term basis, but there's not enough selling power there to sustain it. So the question is, do you see this disruption, this possible point where the market might correct back a bit? Do you see that as a problem, or do you see that as a fantastic opportunity? Now, from my perspective, the longer-term megatrends are not likely to be derailed. That's not going to happen no matter what else is happening around the world, whether it be AI or the energy transition or whatever it might be. It's extremely unlikely that any of that is going to be derailed. So for investors, it's a matter of you just got to be clear about what it is that you want to own and how you want to own it, when you want to own it, how you want to accumulate it. And if you've got some patience to wait for the good entries, there will be corrections. It's absolutely guaranteed. Every stock will go through some sort of correction. We just don't know how far upwards they'll run and when that correction will occur, but it will happen. And then you've got to have the clarity and the courage to pull the trigger. So this is not a difficult process, but it all starts with being clear about what it is that you want to own and why you want to own it. What is the time frame that you want to own it over? What is the style of stock that suits your psychology? All these sort of things that I talk about every week and that I talk about constantly with members. And I'm going to cover off what I think is the ideal stock profile at the end of this video. Now, when we look at the money flows, there was certainly, again, on a very short time frame, there is a flight to bonds. And also, I think everyone would be aware of what gold and silver did last week as well. So that tells us a story. That tells us that there are some parts of the market that are extremely nervous. And this is happening at a time when valuations are stretched in general. There are a lot of stocks where the valuations are not stretched because the growth is so strong, the earnings are so strong. But it certainly does bear watching because that combination of stretched valuations and a flight to safety is telling you something about the psychology of the market. So the question is, do you want to avoid it or do you want to embrace it? And for me, it's absolutely a time to embrace it, but you need to make your own decisions. The market sentiment in the US, there is definitely elevated enthusiasm in some parts of the market, despite all the obvious things, the lingering economic issues, the trade tariff issues, just the general policy of the administration on all sorts of things, and also the threat to agency independence, such as the Fed or other markets that produce data. There is also, during the week, came up the issue of regional bank health, and we've also got some private firms that are actually struggling to meet their obligations in terms of debt. And then on top of that, we've got the government shutdown. There's a question about whether that's creating any long-term damage. Difficult to tell at this stage, but it's possible. So there's a lot of things that are going wrong. There's a lot of things that you could be concerned about. But the offset here is we've got an AI boom that's unlikely to stop or get derailed. And we've also got the market expecting there to be at least 2 rate cuts until the end of the year. So they're positives that are contributing, and that's holding the market up at this point in time. Now, will that change? We'll see in due course, but there's certainly plenty of things that could derail the sentiment of the market. But as always, my overwhelming advice is to play it as it comes, not to try and anticipate what might happen in advance. In terms of other risks for the market, margin debt is now in excess of $1 trillion, according to advisorperspectives.com. Now, that is an all-time record. However, it's not an all-time record in relationship to the market capitalisation of stocks in general. On the surface, it looks really bad, a new record above $1 trillion, but you've got to keep it in perspective. The market cap has grown considerably in the last several years. But on top of that, we do have a lot of other leverage in the system. If you add in the options market, which is obviously a leverage market, you add in the cryptocurrency leverage, and also we've got leveraged ETFs on margin. And I suspect that this might be causing a little bit of the very short-term volatility when you've got leveraged ETFs that are also being done on margin. So you've got leverage on leverage. This is why the market is reacting in the very short term in a very volatile fashion, because of all of this build-up of debt and margin. And all of that can lead, of course, to a cascade effect. Now, we saw it a couple of times last week over periods of a few hours. At some point, that will develop into something more significant. But we take action when we get to that point. We don't take action in advance, trying to second-guess the market. It just never works out very well. And as always, we strongly advise that you obtain all the other advice that you need, be that financial, legal, or investment advice, before investing on anything contained in this video. All right, let's look at American stocks. The S&P was up 1.7% for the week, and the NASDAQ went up by 2.15%. Despite the volatility, despite some of the scary headlines, that was where the US market finished. The Russell did even a little bit better, up 2.35%. So from an index point of view, it was a pretty buoyant week. US dollar index was down just a fraction, 98.54, and that strong, very short-term uptrend that we saw has been interrupted. 10-year yield rolled over, actually went down below 4, and it's not a great sign if that continues. So we've spiked down below 4%, managed to rally back above it and just hanging on by the fingernails. But if we start to get down below 4% again and we start to trend down, then that is not a good sign about how the bond market is perceiving the risks. The VIX index spiked up. If you remember, last week or the week before, we were trading at around 15. The VIX spiked up to 29. So this was a genuine mini panic, but it finished back down at 21. So the market certainly did settle down. Let's go and have a look at some of the indices. We'll start with the NASDAQ composite. This is on a daily chart, so you can see the significant volatility that we had. That was the Friday before last. And then we just basically bounced around with some sharp short-term moves, but net really not doing a great deal. And I guess the plus 2% for the week is really just a consequence of coming off those extreme lows from the Friday before last. But there's not a lot that you can say about that chart in terms of change of character. We had one very significant down day 6 sessions ago, and then after that, the market has really just gone sideways. So no conclusion can really be drawn from that in terms of the overall risk. And that's why you've got to look. You can't just look at the indices and make a decision on that. You've got to look at a broader base of indicators. Semiconductors always has to be looked at in terms of the health of the US stock market. And you can see it remains pretty much on all-time highs. Now, moving on to the US on a sector basis, we've got technology and healthcare very much at the top of the tree. And then we've got a big gap down to consumer staples, but consumer staples are coming up and coming up quite quickly. So there is a bit of a rotation from discretionary into consumer staples. Not huge at this stage, but again, it's a bit of an indicator of what is happening with sentiment underneath the hood. In Australia, materials certainly did best, gold contributing to that to a degree, but certainly materials outperforming, and also small caps are outperforming significantly over the last month. And then finance is sort of in the middle of the pack, and the Australian technology sector is definitely on the trend down. So that's the way that the Australian market looks at the moment. And this is the S&P. We've got, again, very similar pattern to what happened with the NASDAQ. And in terms of the Russell, on a weekly chart, you can see we set new all-time highs on the Russell, but weren't able to hold it. So that's where the US market sits. If we look at the currencies, you can see we definitely had a slide back on the week in terms of the US dollar. And if we look at the Australian dollar, didn't really bounce the way that you would have expected given the direction of the move of the US dollar, that we didn't really get the bounce that I would have expected here. All right, moving on now to the Australian market. 64.4 was where we finished. And I guess there was certainly a degree of uncertainty and fear in the market. And whenever that happens, we tend to see more of a risk-off attitude to the Australian dollar. The ASX 200 ended up gaining 0.4% for the week. Hard to know how it's going to open on Monday morning because the strength of the US dollar finish. But it was another hugely positive week for materials, as we saw, and also gold and silver. Speaking of which, gold was up $235 to $42.50, just an extraordinary finish, or 5.9% was the overall gain. In Australian dollars, we're now at 65.48, which is an extraordinary number. It was only a couple of months ago I was talking about numbers in the mid 5,000s. So we've added nearly $1,000 Australian in a very short period of time. And of course, that drops pretty much straight to the bottom line for Australian gold producers. Silver was up 51.88, which was up 10.2%. So silver still outperforming, but there was certainly some selling at the end of the week, which we'll get to in a minute. So we've got some fundamental headwinds for gold and silver, offset by the fact that institutions are obviously keen to buy, because we saw support on Friday on an intraday basis at 4,200, and the market was pretty keen to bounce from that level. There's been a real surge in global retail demand of late, so that is adding to what we've seen for quite a number of years now with increased central bank buying. And just on last week, I made mention of the fact that the gold market was of a certain size. I had misinterpreted what I was reading from that particular source. It is, in fact, $30 trillion in market value. It still doesn't invalidate my point that relative to overseas or foreign investments in US treasuries, any move in the US treasuries into something like gold would put a lot of stress on that market, because there's not a lot of excess material floating around the world. So the impact on the gold price could still be significant. But anyway, that's a correction from last week, so sorry about that. When we turn to gold stocks, the macro drivers that we've got are a weaker US dollar, obviously the safe haven status of gold. We've got central bank buying that's been intensifying over recent years, and we've also got a pretty significant inflow into ETFs. We've got some stock-specific drivers as well. So there's big picture macro drivers, but stock-specific, we've got a lot of M&A has been going on for some time, and it doesn't appear to be diminishing. And also the results from exploration, because there's a lot of gold miners that are out there in a bit of a drilling frenzy, and the market is responding to those exploration results as well. So there's the ASX 200 on a weekly chart. So you can see we really haven't gone anywhere since the last trending week finished in the middle of August, and we've really just been going sideways, and it was pretty much another week of the same for the Australian market. Now let's move into the precious metals. Silver, you can see this is on a weekly chart, so that gives you the bigger picture. We've moved since the start of September, so that's 7 weeks. We've moved from just around $40, and we actually hit a peak of $54.50 during the week. So it's been a very dramatic move in silver. If we look at the intraday, so that is a bit of a reversal in sentiment. But again, the buyers, this long tail here indicates the buyers were very ready and willing to step up around this $50.50 mark. And gold, not quite as significant, but it looks a little bit the same, again, on a daily basis. So we've got tails top and bottom. But the way that I see that pattern is it's a likely continuation signal than the start of a reversal signal. We had very powerful momentum up until Friday, partway through. The bears had their chance to take profit, particularly heading into the weekend. We got down to 4,200, but then the buyers stepped back in again. So the buyers still keen to step up to buy those dips. So I think this is more likely that it might either consolidate here, so just hang around this particular level for a period of time, perhaps between 4,200 and 4,300, 4,400, or it might just continue on. So at this point, we don't have enough information to know that direction, but it doesn't matter. We don't need to second guess the gold market and what the price is going to do. We just observe and respond. There's the Australian dollar gold price, and we peaked out at 60, almost 6,800 was the peak. So that's extraordinary level of profitability for Australian gold miners. So let's have a look at what the actual stocks did. So this is the Aussie index covering the largest gold stocks around the world. And you can see there was a huge surge. This is the biggest week that we've seen in the week just gone for gold stocks, gold producers. We finished at 131.4 on GDX. GDXJ, obviously the Australian, that GDX finished when the Australian market closed on Friday, whereas this GDXJ would have traded through Friday evening. So we saw a pullback in the US on Friday night and on pretty decent volume as well. And whether you look at the index or you look at individual stocks, it all looked the same. So we've really got to expect there's going to be some profit taking in gold stocks come tomorrow morning. All right, and just finishing off with other commodities. Copper was at $4.95. We've still got supply risks there, but stock valuations, particularly with the larger producers, are pretty stretched when you look at the PE multiples relative to their growth. So the market has already priced in a fair amount of where it perceives this is going. So just be a little bit careful with copper stocks in terms of valuations. For me, the absolute sweet spot are the world-class developers that have got special projects, special in terms of being extremely large, having blue sky potential, good grades, good mineralogy, all those sort of things, the things that make you stand out in the crowd. And there are number of them that are Australian listed copper stocks that fulfill that criteria. So for me, that's the sweet spot, because the future has not been priced in as much as it has with some of the larger producers. Crude oil finished at 57.64, so it's dropped quite a distance in recent weeks. And it's really concerns about oversupply that are really doing that. So wrapping it up, this is the ideal target profile in general terms. The company's got mega trend tailwinds, so it's in a sector where it's going to get all the benefits of very, very strong trends that are unlikely to change no matter what else is happening around the world geopolitically. They've got strong moats or niches that protect them from their competition, or insulate them, I should say, from their competition. And they've got huge runways for growth. And their market is also increasing. So it's twofold. Market increasing, but also they've only got, at this point in time, a very small percentage of their relative market. They've got excellent growth and profitability. They're getting upward revisions from brokers and analysts. And they've got relatively appealing valuations, again, relative to their growth, not in absolute terms, but relative to their growth. So that is what I spend almost my entire time looking for. That is the ideal target profile. And if you just narrow your focus, forget about all the names that people tell you should own, because that's a balanced portfolio. That is what I spend my time looking for, and that is what has been contributing to the results that we've been getting in specialist share education. Portfolio analyst last week was a week off, one of the scheduled weeks off for the year. But I'm certainly going to be pursuing this theme at every opportunity, and that is that money flows are absolutely everything. It tells you all that you need to know. And so my focus is helping members build their skill base on chart reading, and the more accomplished you can be around chart reading, then the better off you are going to be. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.